What's up, y'all? Welcome back to my channel. I'm so glad that you are here. If you're new here, my name is Jermeen. I am the owner and founder of Visionary Accounting Group, where we serve nonprofit organizations. Strictly, we help them with their accounting and audit needs. And if you're not new here, welcome back. Welcome back. So today we're going to be talking about financial management strategies, financial risk management strategies that most nonprofits often overlook. And so if this is something that is of interest to you or something that you are dealing with, then you want to stay tuned. So when you hear risk, right? Financial risk, I think the mind automatically goes to money. Do we have enough money? Are we managing our money well? While that is a portion of it, right? That's not all of it. For a lot of nonprofits, the biggest risks, right, come to fruition in the form of money, one, but also people, systems, right? And these assumptions that leadership may have that no one is actively managing. And those are linked, right? Those are inherently linked. And so today, the way I want to take this video is I want to talk through some financial risk management strategies, right, that you may not have thought about, right? These are some of the things that I feel like are kind of go unsaid. These risks don't always show up on the budget, but these are things that organizations are dealing with. And because they don't often show up on the budget, sometimes you're not thinking about them and you think that they might just take care of themselves, or sometimes they're not even on your radar. And that's a problem, especially given the time that we're in. So if you are an executive director, if you are a COO, or maybe even a board member of a growing nonprofit, this video is going to be very important for you to pay attention to. Typically, the risks that we see organizations kind of experiencing or dealing with when they come in to work with us might be like an audit finding. Maybe they had a grant that is super delayed in reimbursing them funding, and so now they're having some cash flow issues. It could be a cash crunch that's related to other reasons, right? I was going to say favorite, but this is not favorite because this is no laughing matter, but it's when a key staff member leaves. And that's a big deal because nonprofits tend to have team members that end up being legacy, right? Like the very first organization that I worked with, the oldest team member in the accounting department had been there for 25 years. He worked his way up from bookkeeper to senior accountant and had been there all of those years. And so when any of those risks end up coming to fruition, everyone is caught scrambling. But these are things that we can plan for. And so this is going to lead me to the first risk that we need to mitigate. So the first risk that we need to mitigate, this is money-based, and that is over-reliance on a single funding source. More than any other year, last year, I saw more than one organization close, and this was some organizations that we actually directly work with, and then other organizations that I just know about. And while this risk sounds obvious, it's still often overlooked. So if you have one funder that represents, anywhere from 30 to 50% of your revenue, or one government contract that is keeping your lights on, you don't just have a funding strategy. I would venture to say that you don't even have a funding strategy. You actually have concentration risk, right? And so what you're missing here is that what's going to happen if that funding ever falters, right? And I find that typically when there's over-reliance on a single source, it's because so much time that source has been guaranteed, right? One of the organizations that I saw close last year was funded through a single government contract, but that government agency had been giving them money for years. Okay, so there was no thought in their mind that that funding was going to continue. And when that funding halted, they literally were left scrambling, no joke. And it went from furloughing some people, laying some people off, to then eventually, triggering their noodle budget. But then at some point, there's but so much saving and freezing expenses that you can do before you realize, if we don't get some more money in here, we are not going to be able to operate. And you of all people know that getting funding is not an easy or quick fix. So if this is not something that you have already been working on, it's going to be very hard to get what one might deem emergency funds, right? And so having this over-reliance on a single source, that is a huge risk, and the first step that we need to take in mitigating that is diversifying your funding. And so I know it sounds easy, like diversify funding. Okay, what does that mean? So when you're doing your budget, one of the things you want to think about is, where's our funding coming from? And when you do that analysis and you see that there's over-reliance on a single source, the next question you should be asking is, where else can we pull money from? Where else can we get money from? Do we have a development consultant that is going after grants for us? Are we slated to have any campaigns this year to bring in donations? Are we planning any events or fundraisers to bring in monies? Are we going after, if you're, mainly government funded or something like that, are you thinking of going after new contracts? Because the idea is we need to figure out how we're going to diversify. And that means that our minds got to get ticking on other ways that we can garner funding. Some of the things that we've seen organizations implement is going after earned income, whether it's hosting workshops or selling merchandise, right? These are just some examples. Renting out their space, like ways that they can have a bit more control over their income. And so you want to be thinking about, if this funding disappears, what happens? And if you don't have an answer to that at all, that's where you need to start. The next risk is weak cash flow visibility, right? So let's just say you are, maybe you are funded by a single source. What I'm finding is that organizations don't really have a view of at what point will, money potentially run out. At what point will they have spent down in different budget lines? Where you get this information from is going to stem from how good your systems are, right? So do you have clean financial statements? Do you have a budget that you're actually looking at on a monthly basis and running budget to actuals? Depending on how severe your cash crunch is, do you have a rolling cash flow forecast so that you are looking at this consistently to determine what were our inflows, what are our outflows, what are we expecting to have to spend in the next couple of weeks? Do we have enough money to cover that? If not, what do we do, right? I remember as an audit, there was this term, it was like, if then what? So it's like, if this happened, then what? Like, you ask yourself this question because it kind of gets your mind thinking on what the answer is. And honestly, because if you don't have one, you have to start strategizing. You have to start thinking about, well, what would we do? And because that way, if you have planned for it and you have this plan of what we'll do, in the for-profit world, they call it like this business continuity, right? That way, if it does happen, you at least know where to start versus feeling like, oh my God, I don't even know what to do next. You at least know, oh, okay, let me go back to that plan and see what it is that we said that we were going to do, right? So if you think about it, you have organizations that have successful audits that are very, system-based, right? Very organized. But those very organizations can still struggle to make payroll. And that's not a systems problem, right? That's a cash flow risk. But you should know ahead of time when that payroll is going to be missed. Or you should have known ahead of time that there was going to be a cash crunch. And the way you knew that or know that is by having that visibility of your cash flow, by checking in consistently, right? And so it's not enough to be tracking, revenue, but you have to also be tracking cash, right? You have to know the movement of your cash, and that is going to help you determine the timing of when you pay bills. These days for some vendors, we can choose what cycle we want to be on. And this also helps too. Sometimes you get invoices that, this one might be net 30, this one might be net 60. So we know we have a little bit more wiggle room to pay this one. So our strategy might be we move this to be paid when X funding comes in, because we know we have enough time to do that. It's like chess, right? You have to work the board. And unfortunately, right, because it's not saying this like it's a good thing or a fun thing, this is the nature of the work. And so if you're going to play the game, you want to know how. And so that's what essentially we're talking about right now. So what does the strategy look like if you lack visibility? So you'll hear some people like, well, what's your 90-day, cash flow forecast look like? To me, 90 days is good, right? But I would venture to say, especially depending on your cash crunch, is like, even if it's a 90-day window that you're looking out of, you should be checking it weekly, right? You should be updating weekly. I'll never forget when the very first organization that I worked for, the executive director asked for a daily update. There was this a quick little spreadsheet that we had going. It was a daily update to the cash flow. So literally every morning when I came in, one of the things that I was required to do was to log into the bank account, check the bank balance, see what had hit the bank, and then I went over to our forecast spreadsheet to see based off of what actually is moving, right? What came in, what went out, what's happening in our forecast, what needs to be updated, does anything need to be moved? And so that whole 90-day or 13-week, right, cash flow, it's fine to have it that far out, but the idea is that you don't just set it and forget it. You need to be going in consistently and reviewing it, analyzing, updating, so that you are making decisions in real time, especially if you are literally experiencing a cash crunch. The next thing is you want to make sure that you're monitoring the time gaps between expenses, your inflows of income that comes in, and then reimbursements, right? So unfortunately, we have all of these organizations that get these reimbursement contracts where they have to spend the money first to then get it back. One of the things that I caution my clients against is like, we can't have a delay. And so we have to have an airtight process on how we are tracking those expenses for those grants so that we are submitting those invoices timely. Because if you know anything about these reimbursement contracts, typically if you're late to submit the invoice, they're late to pay you. And I'm not talking about if you're late, once we get it to you, then we'll pay you. No, you go to the bottom of the list. And for some organizations or agencies rather, they move you to the next month. And for many of you, you can't go that much time without being reimbursed, right? And so you want to make sure that you're managing the timing of that properly and that you have a system in place to make sure that you're tracking it, you're invoicing timely. Now, there are two more risks that I want to go through that are less money focused, tied to, right, but just less money focused. And this third one is grant compliance, right? So big one, often underestimated. And I mean, I feel like when I first even started creating these videos and talking on LinkedIn about what I was seeing in the nonprofit space, it was all around grant management, because that was at that time the bane of my existence, because that was what so much of my work was focused on. But it was killing me at how poorly it was being managed prior to us coming in. So one might think if we have the money coming in, if we win the contract, if we win the grant, we're fine. But that's not enough. You have to think about timing. You have to think about documentation, allowability, and proper allocation. And so what I actually recommend is when organizations are even thinking about going after grants is when you find a grant that you want to go after, you need to consider the stipulations of that grant. What all is going to be required? And do you have the bandwidth to be compliant? Because if you don't, then it makes no sense to take that money. And I know that sounds crazy, but it's actually worse to take the money and then mismanage it. A lot of times you don't get those grants renewed. And sometimes you have to return the money. We don't want to be giving people money back. We know that you have real expenses. We know that you're doing real community work, but poor mismanagement sometimes will have others thinking that you're not doing that. Intent is not enough, right? And so some of the issues I often see are like grant expenses not being tied back to approved budgets. So now we have all of these expenses that are not even allowable, right? Poor documentation as it relates to allocation. So now we're trying to do all of this math at the end of the month just to get the invoice in, right? Or just to report on the grant expenses. We want to go into this being proactive, right? So build grant tracking into your accounting system, right? So now we're talking about the strategy, right? Risk management strategy, right? So build that grant tracking into your accounting system and let grant compliance be a part of your month-end process. Meaning if these grant pieces, if you're not following the compliance stipulations here, then your books are not closed. Right? You shouldn't be considering your books closed, right? Review grant details monthly, not just the organization's books, but how are these different grants performing, right? You want to make sure that you're tracking this compliance as part of your operational process. You don't want to wait until it's time to prepare your annual report for the grant to see how well you performed, or did you spend right, or are you in compliance, because then so much time has passed and it makes it very difficult to go back and clean this up. So make sure that you are considering those things. This last risk, key person risk. This is when someone who is very key to your organization, key to your fiscal or your accounting process leaves. What I've seen happen is that when they leave, so much organizational details, legacy information leaves with them. That makes me so uncomfortable. When I come in and I find that only one person truly kind of understands the finances, only one person that really knows how these reports were ever put together, only one person has all of the funder relationships, that's a key person risk. Because if that person chooses to leave, you're naked, you're uncovered, right? That shows up when someone resigns, when someone goes on leave, when someone just ups and burns out and quits, right? You can't leave so much importance in one person. I have talked on here many times about PPT, people, processes, and tech, and how you need to have a good balance mix of the three so that no one person or no one thing is responsible from a process from start to finish. And so risk management here look, there's a number of things that you can do here, but at the very least, documenting your processes, right? When you think about the grant tracker that you have, documenting who those funder relationships are with, what's their name, what's their email, what's their phone number. So making sure that if someone leaves, it's like, who's that contact at that agency? The only email communication lives in that person who left their email. No, cross-train. You should have a backup, right? Or that key person rather should have a backup. If they are out on leave, someone else should be able to pick up where they left off. Part of that, of course, is that documented process, but you also need to make sure that someone else is trained on this, right? Another risk management strategy is to make financial knowledge, so certain aspects of the accounting process, institutional, not personal. So how does X organization do this? How does X organization do that? Not how does Mr. So-and-so, who is the CFO, how do they like it? And this is all the things that we do because this is what they said. It needs to be institutional and not personal. Strong organizations, they don't have heroes. This whole notion that someone came in and saved the day, no. Operate off of having a process and making sure that that process is documented, making sure people are trained on that process, and making sure that if that key person were to walk out the door tomorrow, you're not scared and scrambling because someone else can come in and pick it up. Risk management is not about fear. Risk management is about strategy. It is about resilience. It's about making sure your organization is protected or at least has a plan in place should these risks happen. It's you proactively taking care of your organization and thinking through some of the things that could potentially going wrong and then safeguarding your organization against it, right? It's 2026. We're hearing organizations having more pressure from funders, more scrutiny from their boards, more operational complexity. And so we don't want to, in the midst of all that, throw in all of these other risks that we haven't thought about or at least planned against, right? This video was helpful. Please like it. Please share it with someone who needs to hear it. And if you have any other topics that you want to learn about, please drop them below. Talked about a lot on here as it relates to the varying degrees of, accounting and financial management, financial operations. And so I'd love to speak more on topics that you specifically want to know more about or want me to go in depth about. So leave them in the comments and I'll see you guys in the next one. Bye.